Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
30-year yield starting about 5%, sign of dimming investor demand. We've been talking about this a lot. We saw the move. Equities came down, but it came after that Treasury auction, $16 billion Treasury sale, lackluster demand, moving yields up along the yield curve. But it turns out, Tim, investors are worried about a ballooning deficit.
Yeah, look no further than what's happening on the long end as we speak, with yields higher by 10 basis points right now. Michael McKenzie is rates reporter for Bloomberg News. He joins us here in the Bloomberg Businessweek studio. We were in here on Monday when we spoke about the 10-year briefly, or the 30-year rather, briefly hitting 5%. We've blown past that. Yes. What's the signal that's sending? Is it about the spending bill? Is it about the tax bill?
I think a lot of it's due to that. I think it's really interesting on a day when stocks start to take a hit. You don't see really any pullback in the sell-off in treasuries. The other interesting thing to observe today is that the 10-year briefly got above 460. If you think back to last month when Scott Bessent stepped in and told Trump, hey, let's do a 90-day delay on tariffs because we're close to 460 on 10s. We edged above that just now. And again, you can jawbone the market once, but if you then step back from all the tariff chaos of last month and the highs we saw then, today it's about the deficit. Today it's about a Congress that really doesn't think it needs to be fiscally disciplined here. And the bond market is telling you that, and it's not just the US story. Japan had a 20-year sale this week, very badly received. You're seeing 30-year yields in the US, Japan, UK, Netherlands, all pushing higher. And this is a global revolt that is beginning to take shape here, where investors are saying, if I don't need to own long-dated bonds, I'm not going to own them. And that's why when I was talking to investors today and yesterday, they like being in the front end of the curve. They like being between 2s to 10s. They don't really like the 30-year at all. So if they have mandates that say, please buy these bonds, they try not to, but they do buy some. But at the end of the day, they're negative on the long bond, and they probably have these steepener trades on where they're basically owning 2s and 5s and selling the 30-year.
So does this have to do with, I kind of always go back to this, Michael, certainly yourself, a lot of folks at Bloomberg, a lot of people on Wall Street kind of get the Treasury trade, right, when things are happening. But I do think about the world at large and what it means. Is it U.S. non-investable? Is it just a sign of concerns about the ballooning debt and what it means maybe for the government and spending and entitlements and how it plays out in the economy, what it does to economic growth if there isn't government money to commit to programs to kind of help? So that's
what we're beginning to look at here, because I think what you're seeing here is, if you look at developed world countries, they have aging populations. There is a much greater need now for retirement and medical costs. If you look at the issue with the US budget at the moment, they don't really want to start attacking and reducing the entitlement spending now, because it's just such a huge vote loser. Right. You can understand why Congress doesn't want to do this, but at some point, taxes will have to go up. You can't say, oh, yes, we're looking for sources of revenue. This administration is looking for tariffs. They're simply not going to get enough revenue from tariffs that can sort of offset the plans for cutting taxes in the future. Then we're already starting at 100%. The deficit, the federal debt is 100% of the economy. It's the same in the UK. It's 200% in Japan. So again, investors are looking at the world and going, well, I would rather lend to AAA rated corporates. I'd rather lend to companies that actually don't really need to borrow and probably only really borrowing in order to fund buybacks, rather than to really well-established countries like the UK, like Japan, and certainly the US falls into that boat, unfortunately. I mean, and I think the other thing that's concerning is that when I was asking people this week, okay, we get 30s above 5%, is that worth the trade? Not necessarily anymore, because again, there's this real trepidation now in the bond market at the margins. They're saying, This Congress deal on the budget just isn't really making any sense. It's not going to alleviate the problem. So do we need to send a bigger message to Washington? Yes. This is an issue. and you guys are kind of walking past the graveyard and just whistling along.
We asked our Eric Wasson, congressional reporter up on the Hill, watching this big, massive, big, beautiful bill make its way through Congress. He said, despite what you might be hearing from the White House, it's a deficit increasing package. Yep. And so net, folks, it's going to add to the deficit. Michael, thank you. Really appreciate it. Checking in on that Treasury trade. Our own Michael McKenzie follows the rates market here at Bloomberg News, joining us here in studio.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
The worries that we are seeing play out once again along the Treasury market, the Treasury curve. We had an auction that didn't go so well. Demand was weak there. And so you are looking at really the longer end of the yield curve bopping up in a big way. We hit about 4.6% on that 10-year note, got a 2-year note that has been trading around 4% as well. And so there are concerns again about this massive spending package that's making its way through Congress, has some ways to go, but it also will add to the deficit. And so deficit hawks are not happy about it. Investors on Wall Street aren't happy about it as well. They're concerned. Yeah.
Also checking out what's happening as you peel back the layers of the S&P 500. You actually see Apple as the biggest drag on the S&P 500 right now, followed by NVIDIA down 1.8%, Microsoft, Amazon, Tesla, United Health Group among the biggest decliners as well. I want to bring in Sandy Villery, portfolio manager for Villery & Co., joining us from New Orleans. This is a 4-generation family-run firm, Carol. We speak with Sandy all the time. Sandy, good to have you with us. How are you?
Good. Thanks, Tim. Thanks, Carol. Good to hear from you.
Yeah, good to have you join us today. I just want to get your thoughts on how you're looking at what's happening in Washington, because that's really what we're seeing with the market reaction today, at least with that bond auction that then sent equities tumbling today. What's your view there?
Yeah, I mean, we're very stock focused, but I will say it's impossible not to pay attention to it, because just you look at what happened in 2025 so far, all about the tariffs. Now we've got the new bill that's going to certainly increase deficits a little bit. And to your point, we had auction. The 20-year auction was certainly weaker, and now we're seeing yields back to where we started the year, around a 460. So it's hard to avoid a lot of what's going on and trying to focus on individual names.
Yeah, exactly. And you've got your Villery Equity Fund. I'm looking at it up about 1.6% on the year. If I look at your balanced fund, it is up about 3.4% year to date. How much movement have you guys been making in and out at this point?
Yeah, but we started the year very defensive after a really good 23 and 24, especially for the S&P that's so tech heavy. So we were more defensively positioned. We had some cash. And then when we got into the lows, those early April lows, we started to buy, and we got about 20% through what we wanted to before the market just V-shaped and went right back up. So now we're back to where we started the year, and we're getting more defensive again. And I think if I look at the S&P and how it may end the year, I see about 5,500 or so on the S&P, and I think it's going to be carried down by a lot of the larger cap tech names. So I think defense is going to win championships in the rest of 2025.
All right, so let's talk about kind of where you are committing money. And I'm assuming these picks are something that have been recent buys, but you can correct me if I'm wrong or right on that. Republic Services, we're talking about a $78 billion market cap company. We're talking about waste management. Stock has had quite a run this year, 26%. Recent buy, adding to it, lay it out for us.
Yeah, I would still buy it. This is an incredible business. It just as long as people continue to get their garbage collected, we feel good about it. It's a mid-single digit free cash flow compounder. They just had a great quarter, and they're getting more into recycling. They've got 2 polymer centers, so fundamentally they're doing everything right, and it's where I want to be, which is larger cap defensive. So I think it's gonna do well throughout the duration of 2025.
Another name that you like on holding, I own their footwear, their sneakers.
Full disclosure.
Full disclosure.
She's not wearing them right now.
Talked with their, CFO. So like we've had them on, we've talked with them. This stock has been on a tear. You're talking about up about 57% in 2023, up about 103% in 2024. This year it's up just shy of 9% here. Again, how long have you owned it? Have you been adding to the position? What are you doing on this one?
Yeah, we bought it, frankly, not much longer after the IPO, which is all the way back in 2021. So we've had it for some time, and that's kind of our style, is to buy and hold, over time. We did add to it not too long ago, and we still think it's going to do well. Now, if you do have a choppy market and things are weaker, this is a great name to add on any weakness. They're just getting started still, in my opinion. Probably grow earnings at 25% over the next 3 years. And they're starting to get into apparel. They're getting more stores out there, probably closer to 100. And if you're worried about supply chains, they get about 80% through Vietnam as opposed to China. So I just feel like it's still going to be moving in the right direction. And if you get some weakness, you get an opportunity to add to it. And I would. Did you buy in early April after it was hit? This wasn't one that we bought in April, unfortunately, but it's up about 60% since there. I didn't either, so I'm with you. But yeah. Okay, you didn't. Yeah, we did. We bought two other names, but what an opportunity! And anytime you can buy a great company like this that is still just running on all cylinders, and in our opinion, is you buy it on weakness. We had other names we wanted to add at the time. What you said you added two other names off of the April sell-off. What were they? I'm just curious. It's interesting. One is a company called Pinnacle Financial that is a bank in Nashville that we really like, and our intention was to take a larger position. We just never got the opportunity to do so. Unfortunately, just because of the V shape. All of a sudden it was just got to a multiple that was a little bit too high. And we added to a little bit of Stryker, just knee replacement, hip replacement, probably on the safer side of what was going on at the time. So like both names, but unfortunately didn't get a chance to fill at least the Pinnacle. Oh, okay. So in other words, you did buy Stryker at the low, but Pinnacle, you saw it, wish you had, but hadn't bought it. You didn't buy it at the low. So not to get into too much, but we bought about 20% of our position. And then by the time it V-shaped, we were sort of boxed out from finishing it. Okay. So we actually kind of sold what we had, and we look to add it if we do get more choppiness in the next month or two.
Pool Corporation. I pulled up the DES page on the Bloomberg terminal. It's down a little more than 10% this year. I actually was expecting it to be lower because I recall late last month, the company reported earnings that they essentially said fiscal year earnings per share will come in just about what analysts saw, but they did report first quarter earnings per share that came in shy of estimates and first quarter net sales that came in shy of estimates. This one was surprising for me to see on your list of stocks that you're bullish on, because isn't the concern the company essentially said the environment was weighing on new pools? So not necessarily a name that you would want to own in an environment where consumers aren't spending money, no?
Yeah. So what happened in 2023, there were about 70 to 75,000 new pools built, and now we're down to about 62,000 as you closed out 2024. So about 15% of their business is new pool construction. It does carry higher margins, and it's a great part of their business. But 2/3 of their business is just repair and maintenance of your swimming pool. So this is a true, long-term hold where, as long as people are putting chemicals and chlorine into their swimming pools, they're remodeling, and basically every 10 to 12 years, you might have to replaster. These guys are as big as their top 10 competitors combined. And so when you get weakness in one little part of their business, new pool construction, which is important, and that kind of pushes the stock down to a reasonable valuation to us, it's a great opportunity to add. If you get any strength in new pool construction, and look, today's interest rates aren't helping, right? People aren't going out and trying to borrow money to put in a new pool. But in general, you get any sort of strength out of already, diminished expectations from analysts already that have taken their numbers down. I think it's got, could be a $350 stock, in my opinion.
Hey, one thing I'm curious, Sandy, at this point, are you higher in terms of your cash allocations in your funds right now, kind of keeping some powder dry, lack of a better expression, but often used, right, in environments where we're not quite sure what's happening next? Are you keeping more money handy and ready to put to work than you normally do?
Yeah, we do have higher cash levels, and we sort of came into 2025 like that, and then we tried to invest what we could. We just didn't have a long enough. We didn't think the whole market malaise would be 3 days, and so we didn't have enough time to put it to work. But now we did raise a little bit more cash, and so we are cash heavier than we have been. And it wasn't necessarily that we were worried about valuation or things like that. We couldn't find new stocks to buy that really met our investment criteria of being cheap. So we go to the sidelines. We will get a little bit over 4% in money market and just wait for those opportunities. And ideally, we see them maybe over a week or summer.
I've heard Warren Buffett say the same thing.
Yeah, no, that's right. And it's funny talking about pool. Berkshire Hathaway did just increase their position middle of May by about 900,000 shares. So they become a top 5 shareholder. So good company with those guys. But yeah, no.
What are your people really try to parse through every single thing Warren Buffett has to say at annual meetings and whenever he opens his mouth to try to figure out what exactly he's going to buy next. What are your, as a value investor, what are your parameters in an environment such as this to say, okay, I'm ready to get off the sidelines and buy this individual company?
Yeah, and that's where we were in that those April lows. We've got a laundry list of 10 names that really meet our criteria, which are just having a company that just absolutely dominates their niche, and Pool certainly fits that build. On Semi, Republic being the number 2 player behind Waste Management, but a really dominant franchise. That's what we're looking for. And many times you have to pay up for those types of businesses. But if you get market uncertainty and things that are going wrong from a macro or a DC standpoint, and you can get into one of those businesses, that's what we always look for.
We've gotten that, Sandy.
Yeah,
market uncertainty, right. Questions about the outlook. I am curious, in a day where we're all, seeing nervousness, risk off, come back into the equity trade and seeing those yields move up again. An argument that, go back 10, 20 years, we had concerns about the U.S. federal deficit. So I am curious how that factors into, I understand you're a stock picker, you're looking for valuations. Are you anticipating an environment where stocks are going to get beaten down even more? Maybe we even go into recession, and that's an opportunity for you? Or are you a little bit more worried that it's something more problematic? Or you're saying, this will turn around?
Yeah, I do think as yields pick up, I mean, if yields keep climbing, and I do think that's at the end of the day going to dampen equity returns as those go a little bit higher. I think there's when you look at tariffs and everything else that are going on, I think that causes boards of directors of publicly traded companies to sort of pause on some of the things they may have been doing. And I'm not calling for a recession, but I am calling for a little bit of a slowdown. And I think there's going to be better opportunities as we get further into the year than maybe we have right now. I mean, it's pretty amazing that the S&P was down almost 18%, and now we're back to break even. I'm sort of looking, towards the end of the year where I think that if you looked at a Vanguard value index, I think it could outperform, say, Vanguard growth. And if you look over the last decade, growth has outperformed value by about 7% annualized. So I'm also looking for some reversion to the mean. So in general, I'm trying to find those cheaper, dominant companies in the market and trying to avoid some of the larger cap, expensive, Mag 7 names.
What portion of your assets under management right now do you have in cash?
I'd say in general, we're probably like 14 or 15%.
And what do you typically
higher than we normally are?
So what's your normal?
We're probably closer to 4 or 5%.
Okay. What do you anticipate going? Look, you can't see the future. None of us can. But just in terms of the way you're thinking about this market environment, do you anticipate getting to that 4 or 5% level this year? Or are you willing to stay on the sidelines until next year?
No, we do not like to be this cash heavy. And again, it's not that it's more of a buyer strike, right? We just can't find those companies that are cheap because they've just rallied on this V-shaped recovery that we've just had. So I hope to be, 97% invested, as we get through the year. We just need to find those names and put that cash to work. So a bit of an anomaly to be this cash heavy, frankly.
Sandy, really quickly, 30 seconds. Anywhere along the U.S. Treasury curve that you find attractive, or are you just staying away at this point? I know you're in corporates and other things, but I'm just curious when it comes to U.S. Treasuries.
Yeah, I would say if maybe they rallied a little bit further, maybe we'd get more interested in picking up some. We do have, about 25% of our balance fund in corporate bonds. We like to buy, triple B, single A.
No, but I mean in terms of treasuries, anything in terms of U.S. sovereign, or are you just staying away?
No, we're staying away. In our opinion, just looking at corporates versus treasuries, we think you get paid a lot more in corporates versus what tends to be risk free. And so we'd like to pick up a little bit more yield by doing a little bit of research and buying some, maybe some, on the lower end of investment grade, corporate debt.
This is exactly what Michael McKenzie told us earlier in our program.
Yeah,
why buy treasuries when you can go and buy from companies? Totally.
Like it makes sense, right? Hey, Sandy, be well. Sandy Villery, portfolio manager for Villery & Company, joining us from New Orleans.
This is the Bloomberg Businessweek Daily Podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, we last checked in with Jenny Rook in February of this year. It was take your time machine. Okay. This was in the midst of a lot of the news about federal money being pulled from universities, a pullback in spending that traditionally goes to research. And what we've heard since then, and what I've noticed since then, reading books, reading articles, reading about innovations, is a lot of what I've read about is this whatever X can trace its roots back to public funding.
Yeah, it's really important, right? The early development starting in so many federally funded projects. Let's get into it because we know she's got some thoughts on this. We've talked about this. Jenny, of course, Jenny Rook, founder and managing director of Genoa Ventures. It's a VC firm that invests in, as she says, the quote, next generation of companies at the convergence of technology and biology. So much going on when you think about that and layer in AI. She joins us here in our Bloomberg Interactive Broker studio. It is good to have you back with us. What's amazing is somebody said to me, what is it, February, March, April? Got to use my fingers.
A lifetime.
Three months, but a lot has happened.
So much.
It's crazy.
From the administration. And especially things that when we think about funding that goes to universities, different projects, NIH, like I'm just thinking about it, where so much can come out of it that we take for granted today, but also creates companies, adds to the economy. Tell us how you're kind of taking all of this in and then your world in terms of investing in it.
No, you're quite right. Thanks for having me back. It's such an important topic. And it does sound like you've been looking into it since I was here last. And finding just how much of what gets to market started as basic research, funded by the federal government, sometimes decades before it became something that we can benefit from as consumers, as patients, as just regular citizens. So as I've been talking to, we talked last time about large, well-funded universities. Are they really going to be hit by this? And certainly the numbers are quite large for those. But what's important to know is that these kinds of discoveries can come from anywhere. Right? They're often a passionate researcher in a university that might be in a college town, that might be the only industry in that town. And so not only the funding that drives their particular projects, looking into, for example, the mechanisms of a cancer gene, but also the dollars that then go through the indirect funding to that university or college so that it gets to keep running as a business and keep supporting its local ecosystem. So I'm seeing kind of up and down the chain, regardless of whether you're Stanford or a college you haven't heard of, it's really resetting how people are thinking about what they can get done in their labs and in their institutions.
I know I've talked about this book quite a bit over the last couple of weeks, Carol, but we're hoping to get the authors on the program, Abundance, Derek Thompson and Ezra Klein. And one thing that I learned in that book was that the inventors of the mRNA vaccine, who won the Nobel Prize in 2023 for mRNA, their work in mRNA, they essentially toiled in obscurity for decades.
Yes, that's right.
And that story is more the norm.
That's right.
Than it is the outlier, it seems. And that was something that kind of blew my mind because you have this research being done and it doesn't seem like it's going to amount to anything until it does.
That's right.
That's kind of the world that you live in.
That's kind of the vibe. Yeah. It's why we call it discovery. Development is another thing. When now you have something, it kind of works, you want to turn it into a product. That's a great place for venture capital to step in. We love to engage early with those companies. But the discovery portion, you often don't know what you're looking for. You're just curious, right? You're picking things apart. You're turning over rocks.
So how patient are your investors when it comes to this stuff? Because you're not, investing in an app that has high margins and is going to, be a game. If we're thinking about this, like in the last 15 years of venture capital and what the winners have been, you're not investing in a social media company that has to go viral and become a top app in the App Store, for example.
Well, certainly the journey for a bio or science-based company, a deep tech company, being venture-backed and then becoming a great exit for LPs, those are very different. And the kind of capital you need and whether regulatory matters, which is another thing we could talk about.
Right.
Those are pretty different versus an app, as you say. But the rules of venture capital are still the same. In 7 to 10 years, you need to give your LPs back 3x net. Now, very few VCs manage to do that, but you can still find winning playbooks in the sciences that work for that journey, and that's what we're trying to do, and other life sciences VCs do.
Hey, one thing I want to ask you. I just want to rehash for everyone who's listening at this point, because we are seeing markets pretty much hover near their lows of the session. So we're still down about almost 1.8% on the S&P 500, down about 105 points, down 2% on the Dow Jones Industrial Average. NASDAQ 100 down about 1.6%, down 343 points. This, as we've said, really the focus is on the Treasury trade, as we've seen yields move up, a 10-year note with a yield of 4.58, so just shy of 4.6, although we hit that earlier. But really at the longer end of the yield curve, we've seen also yields move up. When we think about the volatility within the market environment, for you as an investor, are you going to be more cautious in an environment like this? Or are you able to maybe make a bigger investment in something because there is stress out there? I'm just curious how that plays into your world.
Yeah, I think most early stage VCs, ourselves included, are already taking a lot of risk, and that is our job, right? To take well-characterized risk that in the long term can deliver outsized returns. And so temporary volatility doesn't change our day-to-day strategy typically. What it does change is the availability of capital to deploy against that strategy. So investors, LPs who are thinking about all of their asset classes, who are dealing with so much volatility and uncertainty, it can be very challenging to have the long-term discipline to say, now is a great time to put money in a 10-year illiquid asset with the hopes of upside. Even if they have that discipline, it can be hard to even just create the bandwidth to find great venture opportunities. So it's a tough time to do the next venture thing, I would say.
It makes it tough. Jenny Rook, we're talking with. She is the founder and managing director of Genoa Ventures, a VC firm that invests in, as we talked about, a lot of life sciences companies, looking at that cross section between technology and biology. We talked about the volatility in the markets and how it's impacting perhaps you, Jenny. There's a headline that crossed coming from the Wall Street Journal that RFK Jr., of course, key in terms of health and human services for the government, chief advisor to the president, expected to criticize vaccines. We saw some movement this week in terms of vaccines that was seen by vaccine makers, Moderna and others, that maybe it wasn't as bad as everybody thought it might be in terms of approving vaccines for some folks. I'm just curious how policy out of Washington, regulatory environment and so on also factors into how you are investing, where you are investing.
This is a really important question because regulatory, of course, is critical to making sure that safe, effective medicines, interventions, foods are regulated, get to the public in a timely manner. Right. And so venture capitalists often, surprisingly, actually embrace regulatory because it's a way to make sure that something gets to market in a way that will be accepted and effective. With patients, for example. And so what's important is to have kind of clear rules of the game. What is required to show safety and efficacy? On what timeline will a regulatory body review those data? That's what's so important. And that's where we're really seeing a challenging set of headwinds as venture investors, where we're often funding a company, just enough, or maybe just slightly less than enough to get to the next milestones, which may be regulatory approval. And if that's going to take an extra 6 months, that can kill a company. They don't have the funds to get through that.
What, in your view, is the long-term implication of this FDA, this HHS, under Secretary Kennedy?
Well, if I knew, that would be a different
You are a venture
strategy.
capitalist, so you are supposed to know the future.
Yeah, we're supposed to take important risky bets. So I don't know, again, what the journey will be, but perhaps one of the upsides to taking these very long-term bets is when I think about a company we might invest in today.
Okay.
Do I believe we will have a functioning FDA that is science-driven and looks at novel medicines and tries to get them to the public in 7 to 10 years? I do. We will still have that, right? Will the timelines be different? Will the requirements be different? Could be. But one of the things I love about science is that it invites inquiry. It invites being tested. It invites discussion amongst people who are trying to work for the same outcomes. So I'm a long-term optimist, let's say.
Hey, Jenny, one last question, because one thing that has become a narrative and a trend is investors looking outside the United States for opportunities. Is that something you are increasingly doing as well?
This is real. We always look at Genoa, we look globally for the very best opportunities, as you were describing, at this unusual convergence of bio and tech. And we look broadly outside of healthcare, food, industrials. But what I am seeing, I just came back from a meeting in Paris focused on industrial bio, which is making industrials like chemicals through bio routes. What I'm seeing is a couple of things. The mood there is lighter than here, for one thing. They're not wrapped up in our drama. And
You sure it's not the wine and the good food? Because everything...
and the cheese. They put out a great cheese plate at break as well. But there is less willingness to deploy their capital in U.S. companies, which had been, in the startup space, the darlings of the venture capital community. So we're seeing capital shift, and this is true, as you well know, in the public markets as well, up and down, whether it's a startup or a publicly traded leader to Europe.
People have been said, it's a rebalance. Everybody was too overexposed to the U.S. Do you think it's a rebalance, or they're saying, I'm not so sure I like the U.S. environment? Just got about 30 seconds.
I think it's the latter, and I think it's going to make, it's a great opportunity for European investors and European companies to attract some U.S. capital that perhaps wouldn't have looked outside.
Great perspective. So glad you stopped by again.
Yeah, thanks for having me.
Always good to have you here. Jenny Rook, founder and managing director at Genoa Ventures, joining us here in our Bloomberg Interactive Brokers studio.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
The world is diced and sliced in so many different ways. So you want to know something about rare earth minerals? You just kind of type in NI rare earth minerals.
What'd you find when you did that?
Okay, there's a store in the terminal, Russia's largest oil producer, buying a giant Siberian rare earth deposit, which may become an area of cooperation with the United States. I think that's kind of cool.
That's
We're
really
talking about Rosneft, obviously the state-run energy oil company over there. But I just think about, there's a lot of jockeying going on right now when it comes to rare earth minerals. We're seeing that happen in a big way.
Yeah, I think that's fair to say. And that's exactly why we wanted to bring back Joe Doe. We talk extraction, we talk refining, we talk manufacturing. When it comes to rare earth minerals, the next company knows all about it from A to Z, and it's happening right here, Carol, in the U.S.
It is indeed. So let's get to our guest. James Litinsky is here. He's co-founder, chairman, and CEO. It's a $3.3 billion rare earth mining company. It's called MP Materials. It's up about 30% year to date. So we just wanted to lay that out. Also with us is Bloomberg News metal mining heavy machinery reporter Joe Doe. I'm rushing because I want to get to you. I want to get to the guest. Whenever you jump in the studio, I want to rush to you. Joe, it's great to have you here. You said to us, we've talked with you a lot about rare earth minerals, and you said, we got to talk to this guy. Tell us why we have to talk to James.
Well, so James Litinsky, Jim Litinsky, he has been running MP Materials now for years. Basically, Jim took the old Mountain Pass Molly Corp company that had gone into bankruptcy and has turned it into something investable. Jim can kind of give you his, 1-2 on everything, but basically they're right at the center of so much of what Donald Trump is focusing on: critical minerals, rare earths. Where are we going to get it? How are we going to rely less on China? The processing, the magnets, everything.
All of it, right?
All of it, right. And it's a lot of questions that I have for Jim too, like, hey, what do you think when the president of the United States is looking at people like you and saying, do it all?
Jim, what do you think?
Hi, nice to see you guys. Joe, good to see you again. Yeah, it's certainly a very exciting time for us. As you mentioned, we're the only company in the world, and that includes Chinese industry, that has the expertise from the resource all the way through to the magnet. And what I stress again and again, when we think about rare earths, because it's very topical, a lot of times people talk about extraction. You hear Ukraine, Greenland, deep sea mining, or even today with the president of South Africa getting a stern dress down in the Oval Office talking about how he has rare earths too. We could have all the rare earths in the world, but if you can't refine them and turn them into magnets, you don't have a solution for the issue.
So, Jim, do you have that solution right now? Because we spoke with Joe a little earlier this year, and he reminded us that it kind of doesn't matter if you can extract it here in the US. You got to be able to refine it. And in some cases, with some of these elements, 90% of that is happening in China. What exactly can you do on the refining level here in the US?
So, great question. There are two places in the world that you can refine at scale. The Chinese sphere of influence, predominantly China, a little bit Malaysia, and then in California, in Mountain Pass, California, which is our site. We actually, I think some people would be surprised by this, but we refine today more than half of the concentrate that we produce. So we are refining at scale as we speak and expanding that rapidly. So we have brought this capability back to the United States of America, and we're the second largest producer of rare earth materials in the world today.
So one thing I just want to follow, because I think you guys know this world so well, Jim and Joe, but I mean, when you say refine at scale, what exactly are you talking about? I'm just thinking people are listening like, okay, what does that mean?
Yeah. A simple analogy, Carol, would be think of oil and gasoline, right? You could get oil out of the ground, but you can't put it in your car until it's in the form of gasoline, right? You refine it. In this case, you basically take an ore out of the ground, you concentrate it, so it's a highly concentrated ore with the rare earth in it. But then to get the separated rare earth that you would then turn into a magnet, you refine that concentrated ore into an oxide. And then not to lose the audience, but you take that oxide, you turn it into a metal, an alloy, and then a magnet. And just last point on that I think is really critical. At Mountain Pass today, we not only mine and refine, but we now send that ore to a magnet factory that we built from scratch at Greenfield in Fort Worth, Texas. I'm actually talking to you today from our factory, and it's on a street called Independence, so we call it Independence. But we are making auto-grade magnets here at our factory in Independence in Texas with material that we mine and refine in California. And we're in the process of scaling up this facility. We have a foundational contract with General Motors. And so we will be providing General Motors with magnets at scale at the end of the year with material that is mined and refined in California.
Jim, I want to kind of get away from the nerdy science. I know you and I can talk about that all day, but I do want to talk about what does matter to the average person here in the U.S., which is you can't do all of this on your own. You cannot, while you might have the full supply chain, you cannot be the sole supplier of critical materials, specifically rare earths and the magnets. You've said that to me for years. One of the things you said to me years ago was, listen, the point is not overnight being the sole provider to yourself domestically. It is slowly pulling market share away from China. What are the kind of conversations you're having right now on this front, on the statecraft front? And maybe you could tell us a little bit about the MOU you signed with Madden, the Saudi Arabian mining company, just last week on this front.
Yeah, sure. Thanks, Joe. Well, it's a great question. We've said all along our mission is to restore the full supply chain to the United States. We've obviously done that in small scale, and we're scaling that up. But we really want to be part of a broader solution to eliminate the single point of failure. As you mentioned, I was in Riyadh last week as part of the delegation of business leaders from the United States with the president. In the presence of the president and Crown Prince MBS, we signed an MOU with Moody, which is the Saudi mining company, to explore the process of essentially building a vertically integrated rare earth magnetics business in Saudi Arabia. And so what that would mean is we would mine, refine, and make magnets in the kingdom. And I think from their standpoint, it's a really exciting opportunity to create a Mideast hub that could receive feedstock from there, certainly, but also Africa and some other places, and really position them well geopolitically. But more importantly, I would also say that, it really solidifies what we've been saying we are, and I think each step of the way are showing is that we are America's national champion. We're the only company in the world that can provide a solution in-house to mine, refine, and make magnets. And so I think the vertically integrated approach that we've had is starting to be recognized by the world as, something pretty extraordinary that we've built inside MP. And so it was nice that the president and the Crown Prince recognized that. So, we'll work on that.
I mean, it's interesting. You're very much saying it's partners. We don't go it alone. It's not just the United States figuring it out. We'll work with trade partners to figure it out. I think another question I have is you came out of the gates, guns ablazing on your earnings call recently with investors, and you pointed out, listen, it is very important that we work with the administration to figure out the solutions to basically getting a hold of these rare earths and these permanent magnets that are domestically or friend-shored produced. Can you tell us a little bit about the kind of conversations you're having with the administration or even the Defense Department?
Sure. So a really important just background context. If we go back about a month ago to Switzerland with the trade talks with China, at that point, we were, and a lot of people don't know this or maybe don't appreciate this because, they're not in necessarily the rare earth magnetics niche, but we were weeks away, in my opinion, from a shutdowns across our economy in aerospace and in auto because the Chinese had essentially stopped shipping rare earth magnets and our supply chains were really starting to break down. And so obviously, fortunately, we came away with a deal there and we're not going to see those kinds of shutdowns, but we were really close. And that is a leverage point that the Chinese have in any negotiation. And again, whatever your view is on the relationship with China, whether it's, sort of going to be a collaborative relationship moving forward that gets reset or something much worse, we need to take this leverage point off the table. That's our view at MP. That's what our mission has been. We've been at this for years, is let's make sure that the United States of America can produce our own rare earth magnetics. And the reason, Joe, that is so important, and you mentioned DOD, is because as we've seen around the world, physical AI is the future of warfare. We're talking robotics and drones, and I think we see that from whether it's Elon Musk or Jensen Huang talking about the scale of robotics and how large that industry is going to be. It is not acceptable for American companies downstream. We're talking about trillions of dollars of enterprise value, our great leading companies, as well as our Department of Defense, to be reliant on a single point of failure in the Chinese supply chain. And so we serve a critical role in alleviating that risk.
All right. So it sounds like you're making the argument for why the U.S. government should be involved, but is the government, U.S. government, is there appetite for the U.S. government to be a partner in rare earth projects and doing it from A to Z, from mining to processing to permanent magnet production?
There is no question that the United States government recognizes this, and I think that these things take time. But there's no question that they recognize, and Joe was referencing our perspective on the earnings call, which is this is actually very doable. We are, in a very short period of time away from solving this challenge in a large scale. And frankly, MP can lead that effort. And what we said is that MP, we've been at this for a number of years. We've invested over $1 billion of private capital, and since we went public. And then prior to that, we had the good fortune, I guess, of taking control of several $1 billion of previously invested capital. So we have billions of dollars of invested capital. And what we've said is, we'll lead this solution, but it's not fair on our shareholders to expect them to take the risk. We're going to need to do this in a capital light way for MP.
Right.
It should be very rewarding for our shareholders for being in this position. So to answer your question, there will be movement forward, in my opinion. I think it's a question of getting these solutions don't happen overnight, but there's no question that there are a lot of conversations happening with government and industry, and we're leading those. Okay,
so it sounds like government's involved. They're listening, and we should maybe stay tuned for news. What kind of money is needed to be committed to do the proper build out, in your view, whether it's public-private partnership? And just about 30 seconds on that.
Yeah, the really simple answer is we're talking single-digit billions. This is a really simple problem to solve, actually. I jokingly say for the coffee budget on the F-35, we probably could have solved the rare earth issue. This is really small.
Wow.
And so I do think the United States government is going to step up. I think you're going to see industry players step up as well, because this is it's an issue that affects our national security and trillions of dollars of enterprise value. And it's actually a small problem.
You mentioned that we could do this in a short period of time. Give us years or some sort of timeline that we could actually move away from a single point of failure when it comes to this problem.
Well, we're bringing that online now in Texas, right? So where I'm sitting is a factory. You all are welcome to come see it. And so we'll be making magnets at scale here at the end of the year. And then the question is, what percentage of the industry do we need to satisfy to remove the single point of failure risk? Because we don't need to solve 100%, but we need to do a material percentage. And so I think the next step would be for us to lead a solution where we're building, something significantly larger, and then, rinse, repeat to add a number of facilities, both here and as we announced with the MOU, potentially in the Saudi Arabia and other places. So it really is not a huge issue. It's just an issue that requires again, capital and execution.
Right. And I think on that point, it's not just going to be you. It does still require a lot of other actors to come into this space. And I guess the quick follow-up again is, what are we going to see from the government this year in terms of commitments to help this space, your company and others, build out the supply chain on rare earths and permanent magnets?
Well, just to be crystal clear, as we all know, the capital markets can satisfy this problem if the existential issue of the industry is off the table. And the existential issue is Chinese mercantilism, right, is pricing. We've got to get proper functioning economics, proper functioning market economics for the price of these materials and the price of the downstream products. And so there's a variety of ways that the government can force that solution. You've heard a lot of them in the news, and certainly we're working on them. I think you'll see a variety of things across investments, tariffs, tax credits. And so there isn't, sort of one fits all solution. It's really going to be a question of the preferences of government. And certainly you'd have to get some of them on here to ask them directly, or stay tuned for, a solution that you see us present one day. But I do think we're going to see something sooner than later, because we've got to solve this problem.
Yeah, no doubt about it. Jim, really cool. I know we're going to be coming back to Jim Litinsky. He's co-founder, chairman, CEO of the rare earth mining company. So much more than mining, as we know, MP Materials. And of course, our thanks always to Joe Doe, Bloomberg News metal mining heavy machinery reporter. You said we had to talk to him. We did. Good stuff.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.